Hey investors, we're here today to talk about the three S's of investing: SIP, STP and SWP. My name is Deepika Jaikishan and I am from MyWay Wealth. Today, we're going to try and understand the differences between what an SIP, what an STP and what an SWP is, and who are the ideal investors suited for investing or withdrawing from such products. Let's start by talking about what an SIP is. As we all may know, an SIP is a systematic investment plan. An SIP gives you the flexibility to invest a fixed amount every month versus a lump sum. For instance, I know several people who say, Deepika, I will invest when I have 50,000 rupees, or I will invest when I have 30,000 rupees. But I think it works much better if you break that amount down to say 3,000 per month or 4,000 per month and continue that over a period of 12 months or upwards. An SIP helps you invest small amounts to build a huge corpus using the advantage of the market movement and rupee cost averaging. There are various frequencies of an SIP that you could use. It could be a daily, it could be a fortnightly or a monthly SIP. My suggestion would be to go for a fortnightly or ideally a monthly SIP where you're bringing down the expensiveness of the market or probably the risk of investing at its peak by investing once or at the max twice a month on a fixed predetermined date. Do note that this date is chosen by you. So it's ideal that you probably choose this date closer to when your salary hits your account. Systematic transfer plan, or commonly called an STP. An STP works very similarly like your SIP, but unlike in the case of an SIP, the STP is debited from a debt or a liquid fund and moved into an equity fund. The advantage of this is, for instance, let's assume that there is an investor who wants to invest upwards of 10 or 15 lakhs. It may not make sense for him to invest all of that money at one shot. It may also not make sense for him to break that investment into just 2 or 3 transactions. So what a financial advisor or we at MyWay Wealth do is park that money in a debt fund or a liquid fund where it earns about 6% interest and upwards, and set up a systematic transfer on a predetermined or a predefined date suited to you and to us, and the money moves out from the account of the liquid fund into the equity fund account. So quoting the example of the 10 lakhs again, I would probably split that 10 lakhs into 10 months or even longer, keeping the current market scenario in mind, and spread the investment over a 15 to 18 month period, which also gives me the flexibility of moving lump sum amounts into the equity fund in case there are severe market falls. SWP, Systematic Withdrawal Plan. This is probably the least spoken about in the industry or in investors. SWP is actually a withdrawal plan which is mostly suited to those who are retiring or probably closer to retirement. In the case in SWP, what you do is you set up a systematic withdrawal again on a predetermined date for a predetermined amount, and that amount is withdrawn from that particular fund and credited to your bank account. This is an ideal option which a lot of retirees use to help ensure they have that fixed income crediting to their bank account month on month.